first thing we should do when we're choosing a company to invest in is determine why we have chosen this company. Now, the first thing we need to be aware of is we need to be knowledgeable about this company and knowledgeable about the industry that they operate in. Because knowledge is key, and you don't want to be just going investing into some company a friend told you about. That's not really the way we go, because you won't have the patience. For example, in a downturn, if the stock goes down, you might panic because you're not aware of the company, you're not aware of the industry, and that could lead you to sell and make a loss. So we need to have knowledgeable about the company, about the industry that they operate in, because we also need to look at what competitive advantage that company has over other companies. Do they have a standout product, a standout service that other companies in that industry don't have? Because once you determine this will make you a lot more motivated and engulfed in that stock you have. And if you go to hold it long term, you'll be a lot more confident that the stock can return you true value. Let's look at sales and earnings. A positive indicator that you can look at when you're going to invest in stock is that the trends for sales and trends for earnings have increased over time. Even if there's small dips here and there, you need to remember that economic downturns, most companies go through dips in sales and earnings, but just over time, since their establishment, sales have generally gone up, and so has earnings. This is a great indicator that the management within the company are operating the company well, and increasing sales, increasing earnings, that's a stock you definitely want to invest in. We need to look at stability within the company, and how we're going to look at stability is look at history and determine future. When we look at history, we want to see that the company weather economic downturns such as the 2008 global recession. Did the company come through that unscathed? How did they perform throughout that recession? And other economic downturns, how did they fare? Another thing we can look at is futuristically, will that company be selling that product in 10-20 years? Does that people need that product? Do they need that service? Have they been able to transform, become innovative in the past that will indicate to you that they can do the same in the future? These are different things we need to look at for stability. We can also analyze the stock price, the trend of the stock price. If we see massive drops in the stock price, that could indicate that there was errors within the company. Maybe bad decisions on management's point of view that led to investors to sell stock. So we want to see a stock price that's gradually increasing. That's a great indicator that also is a company to invest in. I always have a lot of confidence when I'm investing in a stock, because as a person who has prepared annual reports and who is a qualified accountant, I know how figures are made and what puts them together. But when I'm investing in a stock, I always want to use certain ratio analysis, because these tools are excellent and it'll give you insight into a company, and even better insight into comparing that company against competitors in that industry. And the first one I want to look at and go through with you is the price to earnings ratio. I want to show you right here. Now, why do we look at the price to earnings ratio? The price to earnings ratio helps us to determine the market value of a share compared to the earnings of the company, which will then we can potentially see if a company is under or overvalued. So the price to earnings ratio it's calculated by getting the market value of a share over the earnings per share. Now I'm going to look here, we're going to choose Apple in this example, who need no introduction. We're on Yahoo Finance, which is a great website for financial information regarding stocks, regarding companies. You should definitely look at this website. So you'll see here the price to earnings ratio is 21.84. What does that mean? That means that for every $21.84 you invest in Apple, you yield $1 of Apple earnings. You may think, well, that doesn't sound like a good deal. Well, that's because investors are willing to pay a higher price for an Apple stock, for predictions and growth, for stability. If you want more riskier, you want more growth, you would look for a potentially lower price to earnings ratio in a different stock in the same industry. Make sure you look in the same industry, because when you're comparing price to earnings ratio, you need to compare it in the same industry, because different sectors have different price to earning ratios, different averages across the sector. So you need to compare it in that same industry. So it's a great tool to determine if a company is under or overvalued, and you can use this analysis across the sector of the company you're investing in. Look at other companies, and then you can make that determination. Well, this could be a potentially undervalued stock if the price to earnings ratio is very low, but you also need to consider why it's low. So there might be other variables. That's why we're going to look at other ratios that we can use in conjunction with the price to earnings ratios that will make us come up with a solid decision. Next thing we're going to look at here on Yahoo Finance is the dividend yield of an Apple stock. You can see here the dividend yield is 1.12%. What does that mean? What is dividend yield? Well, the dividend yield is the amount of money that a company pays shareholders for owning a share of its company, divided by its stock price. So you'll see the dividend yield is 1.12% here. That essentially means that the stock you hold, the dividend that the company is paying you out of their annual earnings, is the equivalent to 1.12%. Dividends are great incentive to hold a stock, especially companies with higher dividends. That is also hugely benefit because you're holding the stock, you're gaining capital appreciation on the stock, and you're receiving dividends yearly just for owning the stock. So dividends is a great thing to look at, and a dividend yield is a great tool to look at when you're evaluating a stock. The price to book ratio is a great ratio to use. So how do we calculate it exactly? Well, we calculate it by getting the market price of a share, and we divide that by the book value per share. The book value is essentially the total assets of a company less the total liabilities of a company, and then when you get that book value figure, you divide it by the number of shares the company has. That'll give you the book value per share. Now, it's a great way because imagine you had two companies that you're potentially going to invest in. Sales trends going up, earnings trends going up, similar levels. You're thinking, which one will I invest in? Well, if one of them companies had a lot lower price to book ratio than the other company, that might think to you, wow, this company is actually undervalued, and that could be potentially the stock for you to invest in, because if the price of a share is a lot lower for the book value, the value that you're getting on that balance sheet in that company, the book value, that indicates that it's essentially undervalued compared to that other company. So that is the great ratio to look at in conjunction with the other ratios we've looked at, and you're on your way now to picking the correct stock to invest in. Another ratio you could also look at is the debt to equity ratio. This essentially is a measurement of how much debt the company has to the equity, to the investor's value. So you need to remember that debt finance is more expensive than equity financing. And debt finance is also paid before equity finance. So for example, if a company experienced a downturn, they'd be paying back their loan, paying back the interest before they release a dividend to you as an investor. But you also need to recognize that some sectors, some industries, such as construction, in the construction industry, debt is a lot more common, and debt is usually financed for the projects. So you need to determine which industry you're in, and then you can look at that ratio as maybe a metric for the company that you're looking at. To consider a complete valuation of a company and to really look at not just financial factors but other factors that could determine whether you invest in this company, you could also look at the management team. What's their expertise? How long have they been with the company? There's loads of factors you could look at with the management team. You could evaluate decisions they've made in the past. What outcome has made? Have sales earnings increased in their time in management? People always overlook looking at the management team of a company. There's actually other factors that a lot of investors take into consideration when they're going to invest in a stock. Another one, which you might not believe, is the corporate social responsibility. So basically, people look at, it's available in annual reports of companies as well. If a company is, would you invest in a company that their sales are going up, their earnings are flying, but they're dumping toxic waste in the sea, killing sea life, and they've bad publicity, and there's a lot of bad press surrounding that company? That could be potential fines down the road. The corporate social responsibility, it is an actual key fact to begin to start looking at investors. It really is growing up the ladder, as in one of the high ones to look at from an investing point of view. Now, another thing I actually really like looking at when a company does is when they purchase back their shares annually. Because what does this do? It dries up supply. They're purchasing back shares, so they're not available on the market. And what does that do? The shares that are in issue pushes the price up. There's less supply, and then if you get more demand, that's a big increase for our share price. So I hope you enjoyed today's video, guys. I'm going to bring you a host of more videos on budgeting, savings, more investment videos, and take a look at my video on how to become a millionaire. Pick up the tips in that video and let's discuss, and I'll see you in the next video. Take care, guys.